And I agree that there's some risk. And look, if Bitcoin ripped from here to the end of the year, if we ended the year at 300K or something, then I think we could have a pullback. But I don't feel the euphoria. And I think these longer 5-year trends are just they're just really strong. I think that's the case. I think 70% corrections are in the past. I don't think we'll see that again. The risk I see for people who feel strongly that this 4-year cycle will repeat is that they'll step out of the market and then the market will pass them by.
For years, the crypto market has marched to the beat of a predictable drum, the 4-year cycle punctuated by devastating drawdowns in years like 2018 and 2022. But today, we're delving into a powerful counter-narrative from Bitwise CIO Matt Hougan, who argues that the very foundations of this cycle are cracking. Hougan presents a deeply analytical case that 2026 will not be a repeat of history's crypto winters. His thesis is not a blind call for a supercycle or an end to volatility, but rather a structural argument that the forces that once governed Bitcoin's trajectory are being systematically overridden. He posits that while the old cyclical drivers still exist, they are significantly weaker and are now being eclipsed by new, slow-moving, yet immensely powerful macro forces that operate on a 5 to 10-year timescale, fundamentally changing the game for Bitcoin and the broader digital asset market.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I've been a fan of the 4-year cycle, and you can't dispute that it's been true, right? 2014, 2018, 2022, all terrible years. The core reason I think it won't be true in 2026 has two halves. On one hand, I think the forces that have driven the 4-year cycle are weaker today than they are in the past. You mentioned the halving. I think the halving is programmatically half as strong every 4 years. And you can make arguments around that. But if you think out 50 years, you have to imagine the halving is not that important. We're not talking about very much Bitcoin before and after each halving. So I think that the halving force is half as strong. We've also historically had rising interest rates in 2018 and 2022. I think we have falling interest rates this year. And then we've had blowups as well, FTX you mentioned, in 2022. And I think those are less likely now. So I see the forces that drove it in the past as weaker than they were in the past. And then on the other side of the equation, we have these much slower but very large forces that move on decades-long timescales. So the institutional adoption of crypto, which really kicked off with the Bitcoin ETF, started in 2024. I think that could run for 5 to 10 years of ever higher and higher flows. We have pro-crypto regulation. I think the impact of that will be felt over 5 or 10 years. So it's not that I don't think the forces that created the 4-year cycle in the past still exist. I think they do, but I think they're weaker. And now we have these 5 to 10 year forces that I think are stronger. And as a result, I'm not calling a super cycle. I'm not saying we've repealed volatility, but I think 2026 is going to be a great year. I think 2027 will be good too. If you think about an institution that just started thinking about Bitcoin when the ETF launched and does quarterly meetings, their 8th meeting will be in January of 2026. They'll be just entering the buying phase. So I agree you can have these animal spirits. We may have pullbacks. There may be a little bit of exuberance in the Bitcoin treasury market. I would say that crypto does not feel overly exuberant to me. This does not feel like 2017. It does not feel like 2021. It feels more early stage in terms of the cyclical excitement outside of the treasury space, which I agree there's a little bit pipping up right there. And I agree that there's some risk. And look, if Bitcoin ripped from here to the end of the year, if we ended the year at 300K or something, then I think we could have a pullback. But I don't feel the euphoria. And I think these longer 5-year trends are just they're just really strong. It's still the case that most institutions don't own crypto. I think that will change in the next 4 years, and they have a lot of money. It's a tanker, not a speed ship. Yeah, I'd add one more thing that's been on my mind lately, which is the Bitcoin obituaries chart.
Oh yeah, Moral Well, yeah.
Yeah, there's been few of those recently, right? Because most people now accept that Bitcoin is not going away. And one of the reasons I think we had these 70% pullbacks was there is not many value buyers of Bitcoin. It started to fall and everyone was like, oh, it's over. It's going to zero. But if people no longer think it's going to zero, I wonder if the cushion comes in sooner, right? Like if we pull back below 100K, Are there people who are going to buy instead of letting it continue down to 50 or something like that? I think that may play a dynamic here as well. I think that's the case. I think 70% corrections are in the past. I don't think we'll see that again. I just meant from the political standpoint, if one of the risks to crypto long term is a dramatic swing in the policy, I do think a market where crypto draws down substantially and Democrats focus on it is a potential scenario where there's risk. But again, I really don't think that's the base case. I think once we have regulation and crypto is in Wall Street and in portfolios broadly, I just don't think it goes back. I think we're in a new regulatory world. I think the ETF is a good example of that. Like, we can't not have an ETF. We have an ETF now. It's not going to disappear. And it's sort of a one-way door. And I think from a regulatory perspective, we're moving through those one-way doors. We moved through it on stablecoins. We're moving through it on market structure. I just think we're in a pretty strong place as an industry now. The risk I see for people who feel strongly that this 4-year cycle will repeat is that they'll step out of the market and then the market will pass them by. And that will be a real challenge. And so to the extent that people are planning to do that, maybe do it in half, or maybe do it at a lower level to make sure you have, and I know most real hodlers do this, they don't step out of the market, but make sure you maintain sufficient exposure that if these two factors, institutions and regulation, really do change the game, you're not at zero. But look, no one cries that much over taking profits on a position after a good 3-year run. So I'm not against that. I would just say, be open to the idea that this time it's different. It's happened 3 times. That doesn't guarantee it's a fourth. It hasn't happened 50 times, right? It's happened 3. If you imagine flipping a coin, you can get 3 heads, but that doesn't mean the fourth one will be a head. So I would just say, yeah, it just be open to the idea that it may be different. I think if you imagine a world without Bitcoin, the US is unconstrained in its ability to print money. Because who are you going to fall back to, right? The U.S., is unconstrained on the debt and deficit sides. In a world where the U.S. embraces and allows Bitcoin to exist, I think it has a significant impact on how the government operates at a point. I think it constrains it. It could co-opt it eventually. But I do think it's more evolutionary than sort of parallel world structure.
The core of Hougan's argument rests on a compelling 2-part framework. First, the traditional drivers of the 4-year cycle have lost their potency. The Bitcoin halving, for instance, is programmatically half as impactful with each iteration, its influence destined to fade over time. Furthermore, past bear markets were exacerbated by rising interest rates and catastrophic industry blowups like FTX, conditions Hougan sees as less probable in the current landscape. Second, and more importantly, these weakening forces are being overwhelmed by 2 new institutional-grade tailwinds. The primary driver is institutional adoption, a multi-year trend that began with the spot Bitcoin ETFs. Unlike fickle retail investors, institutions are tankers, not speedboats, making decade-long allocations. Their buying, which Hougan projects could grow from $35 billion in year 1 to over $75 billion by year 3, is steady, programmatic, and largely indifferent to short-term price swings, providing a massive, persistent bid under the market.
It's a good risk to consider of that collapse time to the midterm elections, which would be dangerous for crypto. My base case is that the genie's out of the bottle and it won't come back in. And I would note that, the Genius Act passed with 100 votes from Democrats in the House. It's actually somewhat bipartisan. There's a very squeaky part of the Democratic Party that's anti-crypto. And I agree that in a sharp bear market, maybe with some scandals tinged to it, they would pounce on it. But I don't think that's the base case. I think the base case is that crypto demonstrates its value now that it's able to interact with the real world. The US is relying on stablecoins for financing its debt. Bitcoin is broadly held by pensions and institutional investors. And that part of the market just has escape velocity from a regulatory perspective, right? It's like the internet after the 1996 laws. It's now out there and it's demonstrated its impact on the world, and you can't stuff it back in. So your scenario, the negative scenario you played out is possible and would contribute to a 4-year cycle. It adds cyclicality to crypto if it happens. or maybe a pro-cyclical nature to a downturn. Like a downturn begets more downturn if it's time to the election. But my base case is it's actually bipartisan. The majority of Americans want crypto to succeed. It's important for our national security interests. It's important for our national economic interest. Wall Street is now behind it. I think it's out of the bag, and we're in this new, pretty good regulatory world. And just that they're slow moving. They don't move with the speed of retail investors who moved in and out of assets on a 4-year cycle. As soon as the market turned, they were out. That's just not the way institutions act. They're allocating for the next 10, 20 years. Maybe listeners who have a retirement account from their job, it's not something they think about. They just invest in it every 2 weeks without even imagining what they're doing. That's sort of the way it happens in this space. So once you've made it into the club, once you're part of the portfolio settings, the market could be up or down. They're still going to be buying, and they just move at a different pace. It's like a different kind of investor. So I think that's going to play out for a decade. I think, ETF flows as an example. We did $35 billion in year one. I think we'll do $50 billion in year two. I think we can do $75 billion in year three. I think we can do more than that in year four. That's what ETFs tend to do. Flows tend to increase over time. And I think that's what we're going to see from institutions. I just think they're moving into crypto, and I think that's going to take multiple years, and that's going to overwhelm the sort of 4-year cyclicality. ETFs and companies are buying 5-6x all the new supply. We talk about the relative scarcity of Bitcoin versus gold. Gold inflates at 2 to 3 times the pace of Bitcoin today, and that will probably increase, and Bitcoin is shrinking. So I agree. The longer you dwell on it, it's hard to grok. I think my answer to this time it's different problem.
I mean, I agree. I'm not hitting you with any numbers here. This is
no. I'm with you. I think when you say this time is different, which is sort of what I'm saying, you have to say why. And I think what separates this moment from the last cycle and the cycle before and the cycle before that is we have 2 whys. The whys are institutions are allocating, they control most of the money in the world, and they move slower than retail. And then the whys are, for the last 6 months, we've been on a new regulatory journey that opens up the market in enormous ways. And if you go back to the last cycle, what was the why? We have DeFi. Like, that's not as powerful a why as the largest investors in the world are now allocating to crypto in size to the tune of like $40 billion a year in ETFs. Or we now have crypto regulation that lets Wall Street interact with crypto. Those are much bigger whys than we have DeFi, or we had ICOs and Ethereum, which was like the last cycle why.
A very retail driven cycle.
Yeah. The first cycle was people can buy Bitcoin. That was a big thing. But we just learned, and then we had the 4-year cycle after Mt. Gox blew up. But the last 2, there wasn't a reason to expect it's different. I do think this time there are those 2 reasons, which institutional purchases and regulation. And I just think those are very big factors.
The paradigm shift, as Hougan frames it, is cemented by the second major force, regulatory clarity. He describes the approval of Bitcoin ETFs and progress on stablecoin legislation as one-way doors. Crypto is no longer an esoteric outsider asset. It is being integrated into Wall Street, pension funds, and mainstream portfolios. This integration dramatically reduces the asset's existential risk. Consequently, Hougan believes the era of 70% drawdowns is likely over, as the narrative has shifted from Bitcoin is going to zero to a recognition of its permanence, creating a stronger cushion of value buyers during pullbacks. His crucial warning is for investors who plan to step aside in anticipation of a cyclical crash. They risk being left behind by a market now propelled by slower, more powerful institutional currents. While not dismissing volatility, Hougan's analysis suggests that this time truly is different, not because of hype, but because of the structural arrival of institutional capital and regulatory legitimacy.